In The Intelligent Investor, Benjamin Graham highlighted one ratio that investors should pay close attention to, the price-to-earnings ratio, or PE ratio. The PE ratio can be understood simply: for every $1 a company earns, how much are investors willing to pay to own its stock? Graham suggested that a stock's PE ratio should generally not exceed 15. Ideally, it should be below 13.3. Of course, this is not a strict rule. An acceptable PE ratio may vary depending on market condition, your personal risk tolerance, and the company's specific circumstances. If a company is still burning cash and has not achieved the consistently profitability, it will usually have a negative PE ratio or no meaningful PE ratio at all. Examples currently include Rivian and Intel. Both companies have reported net losses, no PE ratio. Once a company becomes consistently profitable, its PE ratio becomes more useful. For a healthy, established company, a PE ratio between 15 and 18 may be considered reasonable. Take Target as an example. In addition to its potential for stable long-term growth, the company may trade at a relatively low PE ratio and offer an attractive dividend yield. Therefore, even if its stock price does not increase quickly, investors may still receive returns through dividends. During a bull market, however, the PE ratios of growth stocks can rise far above this range. For example, Facebook's PE ratio reportedly exceeded 1,200 in 2013. Tesla's PE ratio also briefly reached around 1,000 after the company became profitable in 2020. However, a low PE ratio doesn't automatically mean that a stock is undervalued. You should also examine other financial measures, including the PEG ratio, debt-to-equity ratio, earnings growth, cash flow, etc.